Hi friends, very good morning. In today's video, I'll be briefly talking about investors should not chase returns. But before that, please note there's a disclaimer at the end of this video. Okay, now the common notion for investors is to chase returns. Now, I've tried to explain this with the help of a small example. Let's say, for example, investor is trying to chase return in a financial assets, be it equities, debt, bond, gold, real estate. Now, what I'm just trying to share, not kind of point out anything plus or minus, but just trying to share a perspective. Let's say, for example, there is an asset called, let's say, for example, asset A, and the investor makes a return, let's say hypothetically, 50% in that asset. Now, please understand that every year will not be the same rosy picture. So let's assume after this, the investor remains invested for a very long period of time and the asset gives the average return, again hypothetical assumption, let's say 10% over the long-term life of the asset. Now, what does that mean? At the end of the long-term life, if you calculate, the return of the asset A will be close to the average mean return, which is, let's say, for example, 10% hypothetically. So, historically, what has been seen that if you do nothing with the asset, more or less the asset replicates its long-term average return. Now, that does not mean that investors should not do anything. But then most of the investors do not have that kind of skill set or acumen to continuously book profits and reinvest money into another better asset class. And even if they do, let's say for example, they move from asset A, book profit, move to another asset B, what is the guarantee you will get the same kind of return? There's a reinvestment risk. There's so many other risks associated. What if the call goes wrong? So it may be possible. Again, this is my understanding. So this is just one perspective which I'm sharing, that we may end up being closer to the long-term average of return of that particular asset. So to summarize, what does it mean? One, the investor should not really bother about timing, because ultimately if you're a long-term investor, the returns would more or less average out to the long-term average. Number two is that don't be, swayed by news about this, that. If you're a long-term investor, be happy with that average return which the asset is giving you. And of course, we are not though great investors. I'm not saying that some of them may be very great, but not everybody is a Warren Buffett, is my point. So rather than timing or doing different strategies, which I'm not discouraging, but even if you're making the average return, it's not a bad thing. So stop chasing return is what I thought in this video. Finally, I'll give the small disclaimer. This is my understanding of things. This is not an advice, offer, or promotion to sell anything. Information is purely for investor education only. You're requested to consult your own financial advisors. Data is historical. Of course, there is no guarantee of the accuracy of facts stated in this video. We will not be responsible for any kind of financial loss on account of the same. Thank you very much. Take care. Bye.